Broadcast is now starting. All attendees are in listen-only mode.
Good morning, and thank you for joining us for today's webinar, What Tax Reform Means for Pass-Through Entities. We'll be getting started shortly, but first I wanted to take a minute to go over the format of today's webinar. If you are attending this webinar for CPE credit, you must answer the 3 polling questions that are presented during the webinar, along with completing the post-webinar survey that will be sent out. All phones have been placed on mute for this webinar. If you have any questions throughout the webinar, please use the Questions tab in the menu. We will address questions at the end of the webinar as time permits. We will also be recording this session, and the recording will be sent out following the webinar. Again, thank you for joining us. At this point, I would like to introduce our presenters. As a partner, Steve Caldwell provides tax planning services to a variety of privately held businesses, including manufacturing, wholesale, retail, and construction industries. He specializes in taxation for privately held regular corporations, S corporations, individuals, partnerships, and limited liability companies. Steve is called upon frequently to provide advice on mergers and acquisitions and corporate structuring. He is a frequent speaker and author on a variety of taxation subjects. Steve was featured by Money Magazine as one of the outstanding tax professionals in the country and authored their annual tax test. As a director in Bloom Shapiro's tax department, Miriam Wisnicki specializes in providing tax planning and transaction advisory services to privately held businesses and their owners. She has substantial experience consulting with partnerships, limited liability corporations, companies, and corporations. Miriam is often called upon to provide tax advice on mergers and acquisitions on both the buyer and seller side. Miriam has worked with a variety of industries with a strategic focus on private equity, real estate, distribution, and retail. I would now like to hand it over to Steve Caldwell, who will begin today's presentation.
Thank you, Jared. Well, today, folks, we're going to be talking about one of the key pieces of the 2017 Tax Reform Act, and that's new Section 199, capital A, the so-called 20% deduction for pass-through entities. This new law has generated an enormous amount of conversation amongst tax professionals and what it means for our clients and how to deal with it. As many of you know, the Tax Reform Act has been touted as an act for simplicity of the tax code. And there are many provisions in the Tax Reform Act that do, in fact, provide more simplicity than we currently have. Unfortunately, that is not the case, however, for Section 199A. It is extremely complex, and unfortunately, because of the way the Act was drafted at the last second, with very little time for review, we basically have a bare-bones statute in 199A that a lot of interpretation needs to be done, and a tremendous amount of guidance is going to have to be forthcoming from the Treasury and possibly Congress in order to clarify a host of questions that the statute itself does not provide answers to. And hopefully we're going to get those answers soon, because the tax community is clamoring for them, as are our clients. Informally, Treasury folks have announced within the last couple of weeks that they understand that there's a great need for clarification of this law, this section of the law, and that they hope to provide guidance sometime before the summer. So we're anxiously awaiting that guidance. My colleague Miriam Wisnicki is going to discuss what exactly is the 199 capital A deduction and what qualifies for the deduction. So with that, I'll turn it over to Miriam.
Thank you, Steve, and thank you everybody for coming today. So today, as Steve mentions, we're really going to be focusing on what is probably the most drastic change for owners of pass-through entities, and that is this new qualified business income deduction. You heard Steve refer to it as the Section 199 capital A deduction. That is because this new QBID, or qualified business income deduction, was codified into the Internal Revenue Code under Section 199 capital A. So those terms are often used interchangeably. You also might hear it being referred to as the 20% deduction. So we're going to start today's presentation with just a general overview of the deduction, some key aspects of it. From there, we'll move on to the basics, who and what qualifies for the deduction, although that term is probably somewhat misleading because there really isn't anything that is basic about Section 199 capital A. And then I will turn it over to Steve, and he will go through the mechanics of the deduction, how it's calculated, what are some of the limitations imposed on it, where is it claimed, etc. The new Section 199 capital A deduction, or the qualified business income deduction, is available for owners of pass-through businesses beginning in 2018. Individuals and trusts and estates, all non-corporate owners of pass-through businesses, can be eligible for a deduction that is equal to 20% of the qualifying business income, also known as QBI, that passes through to them from a qualified trade or business. There are several different limitations that may limit the ability to maximize the full 20% deduction, but Steve is going to walk through those in his segment of the presentation, and we'll leave those for now. But in general, the maximum deduction that an individual or a trust or estate can take is 20% of the qualified business income from a qualified trade or business. It's actually important to keep in mind that even though mechanically this deduction is a deduction, the real policy behind this deduction was really to lower the effective tax rate for qualified business income from a pass-through entity. As I'm sure many of you know, the C Corp rate was reduced as part of this new tax reform from a 35% rate down to a 21% rate. Interestingly enough, the vast majority, something close to 95% of businesses in the U.S. are structured as pass-through businesses, not as C Corp businesses. So in an effort to somewhat level the playing field and provide some benefit to the pass-through businesses as well, Congress was really looking to lower the effective tax rate for the pass-through business owners, and for whatever reason, the simplest way of doing that was by providing this deduction. So now the maximum rate for owners of qualified businesses on their qualified business income is now 29.6%. And the math behind that is that the highest effective individual tax rate is 37%, multiplied by only 80% of the actual taxable amount of the qualified business income, since you're going to receive a 20% deduction. And so that equals 29.6%. That obviously is if you can get the full 20% deduction on your qualified business income. So we talked about that qualified business income would be coming from a pass-through entity. So what types of entities are pass-through entities that can generate this qualified business income? Those entities would include all forms of partnerships, such as general partnerships, limited liability partnerships, and limited liability companies. That is if they are taxed as a partnership, which is generally the case. LLCs generally have the ability to elect to be taxed as corporations, so this deduction would only be available to owners of LLCs that are taxed as partnerships. S corporations, which generally would file a Form 1120-S, are also pass-through businesses. And then finally, sole proprietorships and single-member LLCs. These are entities that have one owner and do not file a separate return for their business. Instead, the activities, the income and losses of the business are reflected on the individual tax return of the owner, either on a Schedule C or on a Schedule E, depending on the nature of the activities. But all of these different types of entities, whether it's a partnership filing at Form 1065, an S corporation filing at 1120-S, or a sole proprietorship or single member LLC filing as part of the individual's tax return, all of them can produce qualified business income that could then be eligible for the 20% deduction. And that's actually a great segue into an important point with regards to the Section 199 Cap A deduction. We talk about how these types of entities can generate qualified business income, but the actual deduction is not claimed on the business entity return or on the Schedule E or Schedule C or Schedule E. Instead, the qualified business income passes through to the individual or trust or estate owners of the business, and then the deduction is claimed on their personal tax return. Steve is going to talk about exactly where on the individual's tax return the deduction is claimed, but for purposes of this general overview, it's just important that you keep in mind that you're not going to find a Section 199 Cap A deduction on a Form 1065 or 1120S. It's not a business entity level deduction. It is a deduction claimed by the owners. Another important point to keep in mind is that owners of these businesses can be either passive or active in the business and still claim the deduction. Previous versions of the law did not necessarily, that was not necessarily the case. There was some distinguishment made between passive and active owners of business in the House bill. In the final form of the legislation, it does not matter whether the owner is active or passive, both can benefit and claim the deduction. Another important point is that there is no basis reduction. So the owners of the partnership or the S corporation, even though they are claiming a deduction that is generated by the qualified business income from the partnership or S corporation, they are not required to reduce their basis in their partnership interest or their S corporation stock as a result of claiming that deduction. Generally, when a partnership or an S corporation passes through a deduction or a loss to its owners and the owners deduct that on their personal tax returns, you would have to reduce the basis in the partnership interest or the stock. In this case, the 199 Cap A deduction does not result in a basis reduction, and that really is reflective of what the true policy considerations were behind this deduction. It really was intended to be a rate decreasing mechanism, not really a true deduction, and that's why there is no basis reduction as a result. And then finally, it's important to keep in mind that the deduction actually is temporary in nature. Due to complicated Senate rules and budget constraints, the deduction will sunset after 12/31/2025 unless Congress chooses to extend it. And this is actually different than the C Corp reduction, rate reduction. That is permanent in nature. So we're hopeful that this will be a very popular provision, the 199 Cap A deduction, and Congress will choose to extend it. But for now, the way that it is drafted, this deduction has an 8-year life and will automatically sunset after 2025. So let's move on to the basics, who and what qualifies. We talked about that a pass-through entity will generate income. That income will pass through to the owners, and the owners can then take a deduction equal to 20% of the qualified business income. Does that mean that all owners of all pass-through businesses are eligible to take this 20% deduction? And the answer to that is no, because for those of you who were paying close attention earlier, the provision is stated that it must be qualified business income from a qualified trader business. So what is a qualified trader business, and what is qualified business income? And interestingly enough, the way the statute is drafted is that instead of simply defining what a qualified trader business or a qualified business income is, the statute really defines what it is not. And we'll go through that now. So what is a qualified trader business? As a general rule, a qualified trader business is any trader business other than a specified service trader business, and we'll talk about that soon, or the trader business of performing services as an employee. So in general, any trader business would be a qualified trader business unless it falls into one of those two categories, the specified service trader or specified service trader business category, or the trader business of performing services as an employee. We'll talk more about the first one in the next slide, but just to give some explanation to the second one, Congress in drafting this statute was really intent on ensuring that wage income, really general, your typical wage salary type income, would not be recharacterized to business income, which would then be eligible for the 20% deduction. The intent was that wage income should continue to be treated at the full, whatever maximum tax rate is in effect for that specific individual. So in the second bullet, what Congress was really probably seeking to do was to ensure that your typical employee wasn't going to set up their own LLC and start contracting the same services they were providing as an employee back to their employer through an LLC. and thereby be able to be eligible for this QBI deduction because the income passing through would be business income. So it looks like they were trying to curb abuses in that area and close the loophole on that. So what are these specified service trades or businesses that are deemed to be non-qualified trades or businesses because they are not going to be eligible for the QBI deduction? So the statute refers to another statute in the code, statute 1202, and lists that the following are specified service businesses which are non-qualified trades or businesses. Those include the trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, or brokerage services. In addition, it also includes services consisting of investing and investment management, trading or dealing in securities, partnership interests, or commodities. And then finally, the statute also provides what has been called the catch-all provision, which is intended to include other types of service businesses where it's a trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its owners or employees. As Steve mentioned earlier, this is really a bare bones statute, and it desperately needs more guidance, especially in this area of the specified service trades or businesses. Because of the way that the legislation was drafted so quickly and mostly behind closed doors, we really don't know why Congress did not want to include these specified service trades or businesses in the deduction. There have been a lot of professionals in the tax community who have made suggestions as to why, but because we don't know why, and because for right now there is no guidance, for business owners that fall into fields that don't clearly fit into the specified service trades or business listing, or perhaps their concerns might fit into this catch-all provision, for those we are generally awaiting guidance from Treasury on this, and they have really clearly indicated that they expect to send this guidance out relatively quickly, and specifically when it comes to the specified service trades or businesses, they view that as a priority so that people will know whether they will be eligible or not for the deduction. There is a special carve-out from the specified service business definition for architects and engineers. So in the initial Senate bill that was drafted, architects and engineers were actually included in that specific listing of specified service businesses. But for some reason or another, in the final version of the bill, they were actually removed from that list. So there is some sort of special carve-out for the architects and engineers. There is also an exception for owners of businesses of specified service trades or businesses if their income falls beneath a certain threshold. If their taxable income of the owner individual or the owner trust or estate falls beneath this threshold, then even if they're an owner of a specified service trade or business, for purposes of the QBI deduction, that business will be deemed to be a qualified trade or business anyway. So if taxpayers have taxable income on their 1040s or on their trust or estate return below $315,000 if they're filing joint, or below $157,500 for all other taxpayers, then they can still be owners of a specified service business and still benefit from the deduction because it will be deemed to be a qualified trade or business. There is a phase out that's applicable for taxpayers who have income between $315,000 and $415,000 for married filing joint, and between the $157,500 and between $207,500 for all other taxpayers, where they can benefit from some sort of partial deduction. But once you hit that $415,000 and the $207,500, you've been phased out completely, and owners of the specified service businesses will not be able to benefit from the QBI deduction. And then finally, the next question is, if we have a qualified trade or business, or if we're below the a taxpayer that has income below the threshold of a specified service trade or business, does all the income that flows through from that business, is that what's used to calculate the 20% deduction? And the answer to that question is no, because it must be qualified business income. So qualified business income is defined by the statute as taxable income from a qualified trade or business, but it does not include the following. So it would include all of your taxable income that flows to the individual on the K-1, but does not include the following items. One, it does not include income not effectively connected to a U.S. trade or business. The term effectively connected to U.S. trade or business, defining it is probably outside the scope of this presentation, but essentially it means that the income has to be domestically generated. So if you have foreign generated income from a qualified trade or business, that will not be included in that qualified business income number from which you will calculate a 20% deduction. Second, investment income, such as interest, dividends, capital gains, investment expenses. All of those types of items will not be included in your QBI income. So even if you have a qualified business, if they're passing through interest, dividends, and capital gains, that will not be included in your QBI number. And then finally, and this is a big hot topic and something that the IRS has indicated they will be providing more guidance on, is compensation type income that is received by the owners from a qualifying business. So for example, if an S corporation shareholder owner is providing services to the S corporation and in exchange receives W-2 wages, or if a partner of a partnership is providing services to the partnership and is receiving guaranteed payments, that compensation type income, those W-2 wages and those guaranteed payments, even though they are received by way of this qualified trade or business, those are not qualified business income. And from there, I will hand it over to Steve, who will talk about the mechanics of the deduction. But we're first going to start with our first polling question, which will pop up on the screen now. For those of you who are looking for CPE credit, you do need to enter an answer to the polling question. So we've gotten a question here. The question was, will the catch-all provision include architects and engineers who were stripped out of the definition? So that's actually a great question. That's been, a lot of tax professionals have raised that question. Wouldn't architects and engineers, yes, they're no longer listed in that first specified service business category, but wouldn't they just fall into the catch-all provision? So by way that the statute reads, you would think so, but Treasury representatives have indicated that that was certainly not the intent, and they do intend to provide guidance and formally establish that architects and engineers should get the carve-out, and they should be able to benefit from the deduction. One last poll reminder for people to enter their answers to the poll question.
So thank you, Miriam. Great explanation. I'm going to now take you through the treatment of the actual steps in computing the deduction and what the limitations are and how they'll affect taxpayers. So as Miriam mentioned, the deduction is actually a below-the-line deduction, as we call it, from adjusted gross income. It's after your adjusted gross income, but it's available to both people who itemize their deduction and people who do not itemize their deduction. So it's a little bit of a different animal. Some people have equated it to a deduction for a personal exemption amount. And as Miriam mentioned, it's really just a way that Congress wanted to achieve a rate reduction for pass-through entities from the 37% top rate to a 29.6% rate for people who fully qualify for the deduction. Again, a lot of this goes into, there's been an awful lot of talk surrounding the Tax Act with the dramatic rate reduction to C corporations to a 21% rate from what was formerly a 35% rate, that Congress wanted to provide some parity between the rates for corporate taxpayers and non-corporate taxpayers, and this was a mechanism to do so. And so folks like Miriam and myself have spent an inordinate amount of time over the last couple of months actually trying to determine whether people are still better off as pass-through entities. As she mentioned, 95% of all taxpayers in businesses are currently structured as pass-through entities, or whether or not they should in fact be C corporations because of the lower C corporation rate. That's a discussion for another day, but trying to understand all of the mechanics and trying to understand who is actually going to qualify for the full lesser rate of 29.6% is really what the treatment of the deduction is all about. Importantly, the deduction is available for both regular tax and alternative minimum tax. So unlike a lot of prior deductions, this deduction is not going to be trapped by AMT considerations. The benefit will be the same for both regular tax and AMT. The deduction is, however, limited to income taxes only. So this deduction will not reduce self-employment taxes or net investment income taxes, etc. So the tentative QBI deduction for each qualifying trade or business is an important concept here, and we'll talk about this in a second, but it's actually, the deduction is computed for each separate qualifying trade or business, and then those deductions are aggregated to compute the overall actual deduction for a particular individual. And the first limitation to the QBI deduction is that the QBI deduction is limited to 20% of the taxpayer's taxable income as shown on their tax return without regard to capital gains. So just to give you a very quick example on that limitation, if, for instance, someone had qualifying business income deduction, but they had, say, $1 million of taxable income on their tax return, and that entire $1 million came from capital gains, they would get no QBI deduction because their $1 million of taxable income for this purpose would be reduced by that capital gain of $1 million in this example, and their taxable income would wind up to be zero for purposes of the mechanics of this test. And so 20% of zero would obviously be zero. So the tentative QBI deduction, this is where this stuff starts to become real fun for people like Miriam and myself and other tax preparers, to go through the actual mechanics here of how the limitations apply. So the tentative QBI deduction for each qualifying trade or business, it's the lesser of 20% of your qualified business income, or the so-called W-2 wage limitation. And the wage limitation, not to confuse you further, but the wage limitation has actually two components of it. And here the wage limitation is the greater of 50% of W-2 wages, or the alternative test, capital test as it's been called, 25% of your W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition of qualified property. And we'll get into what all that means in the next slide or two, but obviously you can see that immediately there's some complication here. And when I talked about the outset about the complexity of Section 199, it's not just the complexity at this point of who actually qualifies, as Miriam was discussing, but once you drill down into the mechanics, trying to figure out what the actual deduction is and what the constraints on the deduction are, you can start to get an appreciation of what people are going to face every year to try and compute this. So the taxable income limitation. So after you aggregate your tentative QBI deduction for each trade or business, then the deduction is further limited to 20% of the taxpayer's taxable income, again without capital gains. So for this portion of the calculation, we're looking at the taxpayer's actual taxable income as reported on their tax return and adjusted for those capital gains. And so then it is the lesser of the tentative QBI deduction, again aggregated for all trades or businesses, or 20% of your taxable income. So we're going to take you through some examples that hopefully will make this a little bit clearer in a second here. One thing I want to point out, and I'll probably mention again, you look at the QBI deduction for each trade or business. So if you have multiple trades or businesses and some have income and some have losses, it is only the income in the current year that you're looking for. You don't have to net the two together. Let's say you have activity A that has income of 100,000 and you have activity B that has a loss of 50,000. In the current year, you would be looking at the $100,000 deduction for QBI purposes, 20% of the $100,000, not 20% of the net 100,000 minus $50,000. So just one of those little pieces of the mechanics that people need to keep in mind. One of the things that we're really struggling with in the tax community right now without any guidance is we talk about the QBI deduction for each trade or business. We don't know what each trade or business means at this point in time. Is each trade or business an aggregate of all of the trade or businesses that are owned by a particular entity? Are there, if say a particular entity has 3 or 4 different trades or businesses, are they all separately broken out somehow? Further on that, if you have multiple entities, but you have trades or businesses in each entities that might be related to one another in terms of the kinds of trades or businesses, are they somehow going to be aggregated? These are all questions that we don't know the answers to yet, and hopefully we'll get some guidance in the next couple of months. So one of the key components of the limitations are W-2 wages, and I guarantee that for people who don't look at this really carefully when preparing someone's tax return, is going to get tripped up on this. So for purposes of the W-2 wage limitation, W-2 wages include wages reported by the qualified trade or business on a W-2 and properly included in a timely filed payroll tax return or within 60 days of the due date filed with the Social Security Administration. So I'm sure I don't get involved in payroll tax return preparation, but I'm sure people take it seriously, but they're going to have to take it even more seriously now because presumably according to the statute, your qualified W-2 wages have to be timely reported with the Social Security Administration, and presumably if they're not timely reported, even though you've paid out these wages that would otherwise qualify in terms of the calculation, they are not going to be includable. So a lot of people have been discussing this issue and how important payroll tax reporting is actually going to be. Another less obvious and not absolutely clear-cut answer on this today is that we believe that when you're looking at wages, that you are looking at wages that are reported on a calendar year basis. So you're looking at what your employees' W-2s actually look like on a calendar year basis, even though your entity, say your partnership LLC or S corporation, might be on a fiscal year. We don't know exactly how the mechanics of that are going to work. Another thing that we hope to get guidance on. The W-2 wages, this is another point that's gotten a lot of discussion amongst tax professionals. The W-2 wages do include reasonable compensation paid to an S corporation shareholder, but they do not include guaranteed payments paid to a partner in a partnership. So a lot of people have spent a lot of time talking about why there's this distinction between amounts paid to an S corporation shareholder that will qualify as W-2 wages, but guaranteed payments paid to a partner in a partnership will not. So there's been discussion, for instance, of, say you have an S corporation that has $1 million of qualified business income, but it's all due to no efforts by any employees, and say a single owner of the business has not taken any compensation either. So there are 0 wages in this particular S corporation. So as you'll see in a second as we go through the mechanics, because there are 0 wages, the qualified business income deduction will be limited to 20% of 0 or 0. So one planning point that people are talking about already, of course, in this situation is to, of course, give the S corporation owner, shareholder in this case, enough compensation to at least qualify for some portion of the deduction. So for instance, if you had $1 million of income and no compensation to anybody, including the S corporation shareholder, you'd wind up with a 0 deduction. But if you said, okay, S corporation shareholder, let's pay you a reasonable salary of, let's say, $200,000. Now we've got qualified wages. So our qualified wages of $200,000 times 50% would mean that we'd have a $100,000 tentative deduction, better than the 0 that we had in the prior situation. People have actually gone through algebraic formulas already to try and figure out what the maximum amount of compensation to any particular shareholder in this situation should be. Since if you understand the mechanics a little bit, the $200,000 that we're paying in this example is great because it increases the wage limitation, but at the same time it's also reducing QBI. So we started out with QBI of $1 million in this example, but if we pay our shareholder $200,000 of wages, our QBI is going to be reduced to $800,000. So there's a bit of a give back here, and the reason for the algebraic formula. I won't bore you any further with that algebraic formula at this point, but it gives you an idea of the types of things that people are talking about. One further important point on what qualifies as W-2 wages is that compensation paid to independent contractors, non-employees, if you will, reported on a Form 1099 do not count for this W-2 wages calculation. So folks need to be careful. In the past, many times for different reasons, it was advantageous to characterize people as independent contractors. But for this purpose, it may be a situation where you want to characterize your independent contractors actually as employees in order to maximize your W-2 wage amount and get over the limitation hurdle. Again, more of a discussion for another day, perhaps. So there's an alternative to the initial wage limitation. As I told you initially, the wage limitation component is 50% of qualified W-2 wages, but there's an alternative to that, and this alternative was really added at the last second to allow for capital intensive businesses that don't have significant W-2 wages to still take advantage of the QBI deduction. So think about real estate entities. Many times real estate entities have very little or no wages, and so without this alternative capital method, they would be limited to 0 or a very low amount perhaps of their QBI deduction. So this was a way to ameliorate that problem. And the alternative test is simply, instead of taking 50% of your W-2 wages, you take 25% of your W-2 wages plus 2.5% of the unadjusted basis of the qualified business's qualified property. We'll talk about that next. So what is qualified property? So qualified property is, first of all, depreciable property used in the production of qualified business income. And it's held by and available for use as of the close of the taxable year. So this is something that is going to trip people up too, I think. So presumably it does not include assets sold during the year. The question has come up as to whether or not an asset sold on the last day of the year would qualify as depreciable property for this test or not. I think that the consensus right now is that it would not, but again, another open question. And the second part of this test is that the depreciable period has not ended before the close of the taxable year. And this is another complexity here that people are going to probably struggle with a bit. The depreciable period is defined as the depreciable period beginning on the date the property is placed into service and ending on the later of 10 years or the last day of the last full year in the applicable recovery period of that property. So just to hopefully drive this point home a little bit clearer about how this works, the later of the 10 years or the recovery period. Let's say that you have a piece of property that has a 5-year recovery period. At the end of 5 years, normally you wouldn't have it be qualified property, but because of the 10-year rule, you'd actually get to use this property in the calculation for another 5 years. So you'd have 10 years in that example from the time that the property is placed into service. Hope it's all clear to all of you. Miriam and I have spent, as I said, an inordinate amount of time on this section 199A. We think that we've got a lot of it down, at least what's knowable, but every time that I look at the section, I find something new to think about or something new in terms of the mechanics and how it's all going to work. And that's before we've actually, put into practice anything, because obviously the deduction, we didn't mention before, we should mention the deduction isn't available for 2017 calendar year taxpayers. It's available for years beginning after 12/31/17, years beginning on 1/1/18. So we haven't actually physically done a tax return for somebody yet. So I'm sure once we do that, we'll find out some more of the minutiae of the mechanics here. As I said a couple of slides ago, the QBI deduction and the W-2 wage and alternative limitations are calculated separately for each trade or business. Therefore, you can't use W-2 wages or qualified property from one trade or business to maximize the deduction for another trade or business. So let's say you've got two trades or businesses, and they both have lots of qualified business income, but one has lots of W-2 wages and property and the other one has very little W-2 wages or property. You can't take the W-2 wages from one qualified trade or business or the property from that trade or business and place it over on the other in terms of trying to maximize the deduction. This goes back to the whole concept of what is a qualified trade or business, though, and are trades or businesses somehow going to be aggregated, or are they not going to be aggregated? If they're going to be aggregated, how do you do that? So it may be that in that example, if trades or businesses are aggregated, the W-2 wages will count because you're putting the two of them together. But again, this is something that we don't know, and we're looking for guidance from Treasury and possibly Congress on that issue. And as I said before, losses from one trade or business don't reduce the QBI from another trade or business. Instead, those losses are carried over to the next year and treated as a loss from that qualified trade or business in the next succeeding year. So it will reduce future QBI from its own trade or business. And I see that we have now come to another poll question. I'll let you answer that. Okay, so if that wasn't clear as mud, maybe a couple of examples will help to clarify it a little bit for everybody. So on this slide here, we've got three activities that all tentatively qualify for the QBI deduction. We've got activity A, a retail business. We've got activity B, a manufacturing business. And we've got activity C, a real estate business. So looking at activity A, the real estate business, and we're just trying to show you here on these slides how the various limitations apply. Activity A has gross income of $10 million. They pay out wages to their employees and possibly owners of $1 million. They have other deductions of $5 million. So their net qualified business income in this example in the real estate activity is $4 million. And their initial tax basis of their qualified property is $500,000. So 20% of their qualified business income is $800,000. So we have a tentative $800,000 QBI deduction from this business here. But then we have to look at our limitations. And this slide, we've deliberately not included the taxable income limitation. We'll go through that in a later slide. Right now, we're just looking at the income limitations subject to the 20% of the qualified business income, and then looking further at the two W-2 wage component limitations. So in activity A, the retail activity, we have 50% of the wages would be $500,000, and the alternative test, 25% of the wages plus 2.5% of the tangible property would be $262,500. So in the retail activity, even though the QBI tentative 20% deduction is $800,000, it's going to be limited to the $500,000, the 50% of W-2 wages here. So our QBI deduction for activity A, retail, tentative deduction is $500,000. Activity B, manufacturing business, $50 million of gross income, $12 million of wages paid to owners, employees, and other deductions of $15 million, resulting in $23 million of qualified business income activity. 20% of the $23 million yields $4,600,000 as our tentative QBI deduction. And now we look at the wage component, and we see that because we have substantial wages here of $12 million, 50% of that $12 million wage limitation leads us to $6 million. The $6 million obviously exceeds the 20% of QBI amount. So in this example, the entire 20% of QBI, the $4,600,000, is allowable. The wage limitation does not come into play in this example. And finally, we have activity C, the real estate activity. And in this example, we're trying to show you how the tangible property works into the calculation. So we have $2 million of gross income from this activity. We don't have any wages paid as is typical in a real estate entity. We have other deductions of $1.5 million. So our qualified business income is $500,000. Our initial tax basis of the qualified property is $3 million. So there are tentative 20% qualified business income deduction. 20% of the 500,000 is 100,000. But now we have to look at our two wage limitation amounts. And obviously, we don't have any wages, so 50% of W-2 wages is zero. And 25% of W-2 wages is also zero. But we have our 2.5% of tangible property, 2.5% of $3 million of tangible property leads us to $75,000 of tangible property in the calculation. So remember, in the wage limitation calculation, it's the greater of the two, the greater of the 50% or the 25% plus the tangible property. So here it yields a deduction of the $75,000. So we don't get the full $100,000, but we do get $75,000. And as I said a bit earlier, when you get to actually reporting this on the taxpayer's tax return, we're now aggregating all three of these activities. And so we have an aggregation of 500,000 plus 4,006,000 plus 75,000 to get a combined $5,175,000. And again, this is a tentative deduction at this point because we haven't gotten into the taxable income limitation of the taxpayer. But we will get to that hopefully on another screen. I mentioned that trades or businesses, qualifying trades or businesses that have losses, those losses don't offset other qualifying trades or businesses' income in the current year, but those losses are carried forward. So just to take you through the mechanics of that a little bit. On this next slide, we're showing qualified business income from Activity A of a loss of $4 million in 2018. So obviously no QBI eligible for the deduction in 2018. But in 2019, they actually generate $2 million of tentative QBI deduction. But because of the loss carry forward provision, we have to take into the calculation the prior losses of the $4 million. So we still don't have any QBI eligible for the deduction in 2019, but we've used up $2 million of our prior losses. And so when we get to 2020, now we've got $3 million of QBI in 2020. We apply our remaining loss carry forward of $2 million, which leads us to a net of QBI tentative 199A deduction of $1 million. So this slide just intended to show you how those loss provisions work and how the carry forwards work and how those losses apply strictly to their own trade or business, not aggregated in the 2018 example with any other trades or businesses that we might have had in that year. Now more fun. There is an exception to the W-2 wage / alternative test limitation. This is very similar to what Miriam explained in her portion of the outline about how certain trades or businesses that don't ordinarily qualify, specified service trades or businesses that don't ordinarily qualify for the deduction can qualify if taxpayers have income below certain thresholds. And this is very similar, that the W-2 wage limitations and alternative test limitations also don't apply to those taxpayers who are below those income thresholds. So the income thresholds, thankfully, for some simplicity, are exactly the same as the income thresholds that Miriam described in the earlier part of the presentation. So it's for taxpayers with income below $315,000, married filing joint, and $157,500 for all other taxpayers. So if you're in that situation, the normal wage limitations don't apply. So those taxpayers whose income fall below those thresholds can take a qualified business income deduction equal to 25% of QBI. Importantly, though, still subject to the overall taxable income limitation, even if they have no W-2 wages or qualified property. And again, just to make it a little bit more fun for everybody, this is not a cliff that the deduction actually, or the exception actually phases out for income levels above 315,000 to 415,000 for married filing joint, and from 157.5 to 207.5 for all other taxpayers. So for instance, if someone gets to 415,000 and they're married filing joint, they will be subject to the W-2 wage alternative test limitation. But if they're below those numbers, then the alternative either partially won't apply or fully won't apply. So, if you haven't had enough already, we'll take you through one more set of calculations, and that's the taking you through how this taxable income limitation works. Remember, on the prior slide, we showed you how the QBI deduction is limited to 20% of QBI, and then perhaps further limited to the 2 W-2 wage limitation calculations. But we did not have in the prior slide any taxable income limitation. So here we're trying to show you what the taxable income limitation might look like for some particular taxpayers. And in this slide, we're assuming that there is no W-2 limitation. So we have individuals A, B, and C. Individual A has qualifying business activities 1 and 2. They generate $500,000 and $300,000 of qualified business income. Individual A has $100,000 of W-2 income. He has itemized deductions, standard deductions of $50,000, and his net taxable income is $850,000. So the tentative QBI deduction for activities 1 and 2 is simply 20% of the combined $800,000. So we have a tentative QBI deduction of $160,000. We have a taxable income limitation, which is 20% of the $850,000 of taxable income, of $170,000. So we have a full QBI deduction here of $160,000. It's not limited at all because of the taxable income limitation. So we start with the taxpayer's taxable income of $850,000, and to determine their overall tax, we're getting to deduct the full $160,000 QBI deduction and wind up with taxable income of $690,000. Individual B, a little bit different. He's got the same $800,000 of qualifying business activity, doesn't have W-2 income, has standard deductions, itemized deductions of $50,000, but his taxable income is only $750,000. So his tentative QBI deduction is the same as individual's A, $160,000, but his taxable income limitation, the 20% of $750,000, in this case is only $150,000. So his taxable income is reduced by not the full $160,000, but the limited $150,000 amount. So there is a limitation here for individual B. Individual C's case, he has $200,000 of business income from activity A, and a $400,000 loss from activity 2, $275,000 of W-2 income, $50,000 of itemized and standard deductions, leaving individual C with a net taxable income of only $25,000. QBI, in this case, tentative QBI, is 20% of the $200,000. Note that it's not netted with the $400,000 deduction from activity, so it's 20% of the $200,000 from activity A. So a tentative deduction of $40,000. But here we have taxable income of only $25,000. So 20% of that $25,000 leads a taxable income limitation of $5,000. So in this case, individual C, even though he has a tentative deduction of $40,000, he's limited to the $5,000. And so his overall taxable income decreases from $25,000 to $20,000 after that $5,000 limited QBI deduction. And we're to poll question 3, I see.
We have a question here. Is there any further guidance regarding the definition of health services as one of the specified service trades or businesses excluded from qualified business income deduction? So unfortunately, no, we do not have any additional guidance yet on that. But as I said earlier, the Treasury representatives has indicated that they are specifically prioritizing providing guidance on these definitions.
So we're just about out of time, but I want to run through 1 or 2 more slides here if I can. Application to partnerships and S corporations. Remember, Miriam said this earlier on in her discussion. The QBI deduction is applied at the partner or shareholder level, but you need to get reporting from, presumably there will be reporting done from the partnership or S corporation, as the case may be. We don't know what the forms are going to look like for partnerships and S corporations, presumably on individual partners or S corporation shareholders Form K1s. There'll be information to tell you how the qualified trade or business income was calculated and what the W-2 wages and qualified property applicable to each taxpayer would be based on the partner shareholders' allocable share of those items. We don't know fully how the allocation of W-2 wages and qualified property is going to be done. More guidance is going to be needed on that, but generally speaking, your allocable share of W-2 wages will be allocated in the same manner as wage expenses have been allocated to the particular individual, and qualified property will be allocated in the same manner as depreciation has been allocated to folks. And again, as Miriam mentioned earlier, there is no basis adjustment to your partnership interest or your S corporation stock. Again, because this was really meant to be a rate decrease and not necessarily a deduction. I'm not going to spend any time on this last slide other than to mention that part of the 199A deduction beyond the qualified trade or business income, 3 other things qualify in terms of the deduction. Those are qualified REIT dividends, real estate investment trust dividends, regular dividends from REITs, not capital gain dividends, not dividends that qualify for capital gain rates from REITs, qualified cooperative dividends, and qualified PTP income, publicly traded partnership income. And these types of income are not limited to the W-2 wage capital base, but they are still subject to the taxable income limitation. So turn it back over to Jared here.
Great. So thank you for joining us today. As a reminder, all slides will be sent out following the webinar, along with a recording of this presentation and some information here for some future tax webinars here at Ben Shapiro. We thank you for joining us today.